Hi, everyone. This is Phil Mattia. I'm the Director of Marketing and Communications for the Feliciano School of Business. We are having a podcast today talking with, let me give you the date. It's April the 3rd right now, because I know things are changing by the day. We're here with Jim Merli, who actually, we did a podcast with him a few weeks ago, back in early March, which seems like a very long time ago, when the stock market, we were discussing the interest rate cut. There was I think it was early March when the Fed cut the rate by half a point. I interviewed Jim about what impact will that have on the market. But now, since then, it's been about 4 weeks ago, roughly, things have changed. So let me introduce Jim, and then we'll talk about this. So Jim is an alum of the business school. He graduated with a concentration of finance and marketing, and Jim spent his entire career in Wall Street at Shearson, Lehman Brothers, at Barclays Capital. He was the head of U.S. primary market syndication until 2010, then moved over to Nomura Securities, and since then retired. He is now an adjunct professor at the Feliciano School of Business. He sits on our advisory board, as well as he's a donor, and he's an executive and resident at the school. He actually sits 2 doors down from me in the building. So welcome, Jim, and thank you for taking the time to talk with us.
Thank you. Good morning.
So since that first week of March when we last spoke, a lot has happened, as you know. Last week, there were 3.2 million Americans filed for unemployment. This week, about 6 million. So over the past 2 weeks, 10 million Americans filed for unemployment. The March jobs report came out this morning, which is April 3rd, 4.4% unemployment rate. We were under 4%, and now we're over 4.4. They reported 730,000 job losses. The stock market has lost, I think, about 30% or so of its value. Before the outbreak, we were flirting with 30,000 on the Dow. And now, and I haven't looked at it this morning, we're probably around 20-ish, somewhere around there.
Yeah, that's right. 21. Yeah.
21. So it's been like a seesaw. It has gone up and down. Also, the Fed has cut the rate to 0%. That happened a couple weeks ago. So a lot has happened. So let's start with the stock market. Why is it so volatile? Why is it going up and down by the day?
Well, obviously, I think the main reason for that has been the virus, and the main reason why that has impacted the stock market is the uncertainty that elicits. Meaning, never before in the history of our country has the government, done the extraordinary measures that they're going through right now in terms of telling people to stay home, telling businesses to close, requiring that people don't go to their jobs. So, the unemployment numbers, the jobless claims, the filing for benefits, those numbers are astronomical and mind-boggling to some extent. But at the same time, they shouldn't be at all surprising. We're telling people and telling businesses to not work. So the fact that people are not working shouldn't be coming as, a surprise. The market doesn't like uncertainty. And the biggest thing that we have right now is the uncertainty of how long this is going to last. When are we going to get to the other side of the curve, as they keep, referring to it. And so, until we get some clarity on the health side of this, we're not going to get stability or clarity on the market side.
And that was the argument with the critics who argued cutting the rate by half a point now to 0%. It wasn't an economic issue, it was a health issue. And now the Fed cut the rate to 0. It didn't seem like it really had major impact on the market. The market didn't jump. I know we had last week, it went up a little bit, and it was up. We had, I think, the best week since 1930 or something I read. But the cutting of the rates, some have argued there was no need to do that. It was a drastic move. And so, why did they do that? Why did the Fed take that drastic measure?
Yeah. So the last time we spoke was, I think it was the day of, or maybe it was the day just after they had made that intra-meeting cut. When this news about Corona was really just starting to, take hold. And I thought at that time that seemed like a premature move. This second move of going to 0, I completely agree with. the markets were starting to seize up. Not so much the equity markets, but the credit markets, the financing markets, the interbank lending that is really the grease that allows the wheels to turn in terms of bank transfers and monies moving from companies' working capital into the markets. That was starting to freeze up. And so the Fed, I think correctly so, basically cut rates to zero in an effort, along with several other stimulus programs that they announced, in an effort to keep the financing markets functioning, which is necessary. It's necessary for companies to, finance themselves on a daily basis in terms of working capital and so forth. So I agree with that, and I think it has helped. It's still not, obviously zero rates aren't having any more effect on coronavirus specifically than, any other rates would. But they are helping things continue to function while we go through this dysfunctional period.
You mentioned the stimulus program. Today's April 3rd. About a week ago, it was signed into law. And I think everyone's well aware of how the program's working, helping those unemployed subsidize their income for 4 months. And there's a lot of helping companies and some things of that sort. So not to get into the specifics of the stimulus program, but what do you expect that'll happen to the country? I mean, they launched it. Checks should be going out in the next few weeks. If you're direct deposit, I read that it may take 10 weeks or so if you don't have direct deposit or if you haven't filed in the past. So do you think, what expected impact will that have on the economy?
I mean, near term, I think obviously it's, incredibly helpful for people to, pay their bills, feed their families, have the necessary financing to, live their day-to-day lives while we get through this. The longer term impact obviously is it's going to have a big negative impact on the deficit, which was already, at record levels and will only be, that much greater when we get through this. I do think, to their credit, Washington, which has not been particularly good the last number of years on responding to needs and moving quickly, has actually moved quite quickly this time around. I think they realized the gravity of the situation and got a bipartisan bill passed in relatively short order. And it's addressing not only the large companies but the small businesses and then again the individuals with the stimulus check. So I think it's going to have a major positive impact on the near term. Longer term, we're going to be dealing with a bigger deficit going forward, which is something, unfortunately is an outcome of this situation we're just going to have to deal with.
And that's the question about the deficit. We know it exists. I mean, what are the negative implications as the deficit increases? Because to the average American, they don't care. Like me, I don't care. You can tell me the deficit, make up a number. Until it impacts the average American, I think no one really cares. But Why does it matter?
Well, it matters because, the government has to finance that in some way, shape, or form. And, typically what they will do is they'll ramp up their borrowing. And by ramping up their borrowings, they will be competing effectively, for investor dollars with companies, with banks, with, other lenders. So rates, theoretically should rise. Now that hasn't been the case for, a variety of different reasons, and different people have different opinions about why that is. But historically, if you're running big deficits and you have to borrow a lot of money to, continue to finance those deficits, you're going to push interest rates up, which, will have a negative impact on inflation. So ultimately, how does that trickle down to the individual person? It's in the form of higher borrowing costs, higher mortgage rates, higher credit card rates, more inflation on the products that you're buying day to day, et cetera. We haven't had that situation in a while. And so, but if you think back to the early 80s, when mortgage rates were 15, 16%, that impacted individuals. Today, mortgage rates are, 4%. So it hasn't been a problem for a number of years, but that's one of the downside risks of running big deficits.
Yeah, speaking of the stimulus, I've read this morning as well as last night about there might be a bipartisan agreement, which is amazing in the Congress and the president, where they were talking about infrastructure. And President Trump ran on infrastructure. Now Speaker Pelosi publicly said she'd be open to do an infrastructure package. I think she's looking at $800 billion. The president's saying about $2 trillion. But then also I heard Kevin McCarthy, the minority leader in the House, made mention that let's wait to see if the stimulus package works before we go ahead and do another. Secretary Mnuchin, I know, has been in discussions with the Democratic leaders about when they get back from Easter or Passover break, I think the third week of April, about putting into play an infrastructure plan, depending on costs and numbers. But the president said, well, Mnuchin said, being that the interest rates are at zero, now's a good time to do it. So I guess my question to you is, do you believe an infrastructure plan makes sense for the country? Will that bring back jobs and bring some life back to the economy? And when you say infrastructure, are we borrowing it from ourselves? That's where I was confused on the 0%, because rates are low. Now's a good time to do it.
Yeah. So, I mean, infrastructure, obviously my opinion is, yes, we're in desperate need of an infrastructure spend in this country. I mean, if you look at some of the tolls and bridges and tunnels that were built 50, 75, 100 years ago, that millions of people are traveling on every day, and the shape that they're in, I certainly am of the view that we need an infrastructure package. And will that help in terms of creating jobs and getting people back to work? Absolutely. So yes, I think that is something, and that, I think it's something that both parties have acknowledged for a period of time is needed, and it's been more them haggling over details. And I think this sort of issue that we're dealing with now, post-corona, will probably make it easier for them to agree, because now it'll be not only, yes, it's needed, but it's needed immediately and it's needed in size. And so I would think that this would help to get something like an infrastructure spending package pushed through more quickly than it might otherwise. With regard to financing it, I think what Mnuchin, was referring to is, again, partly because of this issue that we're dealing with right now, but also we've just been at historically low interest rates for a period of time now. So whether you're a company or whether you're an individual or whether you're a government, it makes sense to borrow long-term money when long-term rates are low. And so there's an argument to be made that with long-term borrowing costs at all-time historical lows, why wouldn't you do that now? You're borrowing money. When you say, are we borrowing from ourselves? I mean, the U.S. Treasury issues the debt. Who buys that debt? Insurance companies, pension funds, foreign governments, wealth funds, other sovereigns. So we're borrowing from a whole host of different folks. I mean, in the recent past, China and Japan have been two of the biggest holders of U.S. Treasuries, as have some other sovereign wealth funds. So there is some concern that comes up periodically about, we're basically borrowing from, some other countries, and maybe more than we should. But the fact of the matter is that, they're willing to buy U.S. debt because it's full faith and credit, and, they're comfortable owning it, and, they're the biggest holders in the world.
So as I mentioned earlier with the stock market, before we began this interview, the market declined. You're hearing these stories of people that are close to retirement have now lost a lot of value in their retirement savings. We were experiencing a bull market for, I believe, 10 years, and now we're fishing a bear market, I think. So the market has changed dramatically. But in your opinion, what should people just ride it out and say, well, should they keep investing in the market? Should they be more safe? Will it come back eventually? again, this is a big crystal ball because we don't really know what's happening with the virus. We're hoping it's contained, but people are afraid with the stock market now, whether they should keep their money in, take it out, or just, be conservative. What do you think?
Yeah, no, it's a very difficult time. It's hard to watch, values go down by 5, 10, 15, 20% and not have some sort of reaction to it. I hate to use the same cliche that everybody else uses about long-term investors, but longer term, yes. Do I think the market's going to go back up? Yes. If you're in a situation now where, you're either in retirement or close to retirement and you're worried about losing any more of your principal, you can put it in treasuries that we just talked about, which are very safe. You're not going to get much return, but you can put it in safe investments there. You can put it in the banks, which the Fed and the Treasury have been very adamant about. They're going to stand behind the banks and provide as much liquidity as possible. The money market funds through the banks that are, insured, the CDs, those are all viable, safe, low risk, low return type of investments that you can look at now. Look longer term, I believe that the U.S. equity market will be back and it'll be strong. It might take a little bit longer than we would like, but some of the companies that are down by 20, 30, 40% from their recent highs, are good quality companies with strong balance sheets that, are going to do well. I mean, so yes, I'm comfortable that things are going to recover. That doesn't mean everything is. And, I think there's some sectors that are going to continue to struggle, even once, we're through this virus period.
The former Fed Chairman Bernanke came out a couple of days ago and mentioned he predicts a sharp decline in the economy, which obviously we're seeing now, but he sees a huge rebound, and I believe it's the third or fourth quarter of this year. We'll see a bounce once this, assuming the virus gets contained and people start going back to work, and hopefully the stimulus plan works. We'll see a rebound that I believe he said fourth quarter. Do you believe that, or you agree with that?
Yeah, again, I'm not, obviously I don't have any more information on the virus than anybody else. So from a health standpoint, I heard someone say, that we really don't know, and we really can't predict, the how and when the market's going to rebound until we have a handle on the health side. Assuming that the health experts that we've all been listening to and watching and reading are correct, that this peak is the next couple of weeks, and we're on the other side of the curve in end of April, beginning of May, then yes, I believe that the economy can rebound by end of third quarter, beginning of fourth quarter. But that timing is going to be obviously directly related to when we get through this, the health side. I think there's going to be a lot of pent up demand for a number of things. People are going stir crazy in their houses. They're going to want to get out. They're going to want to go places and do things and see friends and so forth. So I think we will have a big rebound in that respect. And the economy was doing well before. So it's not like, this is, again, completely unprecedented. I mean, it's not like the economy was slipping and something pushed us over the edge. The economy was cruising along at a strong pace with low unemployment, low interest rates, and we basically put the brakes on. So it was, self-imposed. And once we take that off, I think things will come back. I mean, I'm not sure how quickly people are going to want to get on cruise ships, or how quickly, people are going to want to do certain things that they were doing before. But I think generally, most of this, will snap back.
Yeah, and plus the other thing is, what do the antivirals look like? What about the vaccine? I mean, there's
Right.
some other things that we don't know. I mean, the vaccine, from what they're saying, is about 12 months away. I just saw the University of Pittsburgh came out with a potential vaccine that tested in mice that the mice responded to antibodies. They want to fast track it. J&J is going to have their first trial in September, I believe, a human trial. So it looks like the vaccine's on fast track that hopefully we'll have before the start of next year or early next year. as well as the antivirals. I know they're testing out different concoctions of Z-Pak and hydrochloroquine. I can't pronounce it, some of these names, but
Yep.
there's definitely a strong push financially and resources put behind antivirals and the vaccine. In my opinion, once the vaccine is made readily available, meaning everyone can have access to it, and it's not just a few 100,000. That's really the solution, and I think people will be less concerned. And the second wave that they talk about in the fall that people are afraid of, will be more prepared, clearly, because we'll have the ventilators and we'll have more knowledge on what's going on. And then there'll be people that have already had it who won't get it again. So again, there's a lot of unknowns, but we're hoping things go positive here. So I guess my last question is, if you were the Secretary of the Treasury Secretary or Secretary of the Treasury, what else can we do? What else would you recommend from an economic standpoint? What are the things they haven't done you'd recommend that you say, they really should think about doing this to really fix the economy?
Yeah, I mean, that's a hard question. I was just saying to somebody yesterday, I actually think that he specifically, Mnuchin, has been, doing a great job. I mean, he's been very impressive in terms of negotiating both sides of the aisle, trying to put the politics aside and, working with the Democrats on, their issues to get these bills passed quickly. I watched him last night where, a number of the media were trying to, they were all saying things like, I'm hearing there's this problem with the SBA loans. I'm hearing there's that problem. And he was just, very straightforward. He said, look, I had a call with the CEOs of every major bank. We are up and running. I'm not saying it's gonna be perfect overnight, but everybody's ready to go. And, if you're a small business, contact your bank and, apply for this loan. So I really think that he specifically, out of, many of the others that we've seen, has really done, I think he's done a very, very good job. I mean, I don't know what else they can do other than, continue to sort of reinforce the message, which is, we're standing behind the markets. We're going to provide liquidity. We're not going to let the banks, get into trouble. We're not going to let the commercial paper market or the funding markets, seize up. So I think at this point, it's going to be about confidence. The execution of these plans is critical, and he seems to me like he's on top of that. So, like I said, I think he's done a very, very good job at this point. I think now it's going to be about, getting people to believe, and have faith that, look, this is going to work. This is going to help. And we're standing behind it, and we're going to execute like we said we're going to execute. If people are still waiting 4 months from now for a stimulus check, it's going to be a problem. If, people start getting stimulus checks in, 2 weeks, 3 weeks, whatever, I think people feel a lot better.
Yeah, I think the latest was 3 weeks if you have a direct deposit, but if you don't, I think it's about 10 weeks from what I read. So his background, he's a Goldman Sachs guy, right?
Yeah, he was at Goldman Sachs for a number of years. He was a, senior partner there. And then he kind of went off on his own, and, he was with an investment group that took over a couple of banks and ran a few banks, post financial crisis. He's obviously a very smart guy, and I think he's done a very good job of managing this and just being very straightforward about the facts and not sugarcoating it, and also not stirring fear or kind of overextending or the hyperbole. I think he's been very straightforward, and I think he's done a great job of working with both sides of the aisle on getting things done.
Yeah, I think one of the criticisms of the 2020 plan, which I believe they were able to resolve, in the 2009 stimulus plan, the money that went to large corporations, companies were using it to buy back stock, and it went to executive compensation. In 2020 plan, it seems that they have some type of safeguard so that doesn't happen, doesn't flow into buybacks and executives padding their salaries. So I think they resolve that in the plan. I guess there's someone overseeing it, and I guess someone that manages that money that goes back into the companies.
Yeah, I think that's right, and and appropriately so. The one thing that I get frustrated by is when some of these politicians talk about helping large corporations, or they sort of try to make it demonizing helping big companies. Big companies are comprised of thousands of individual workers. That's who big companies are. It's not some big monster standing behind the curtain. Bank of America has 200,000 employees worldwide. Bank of America is a big corporation, but it's comprised of a lot of individual workers, and those are the folks that are being helped. In terms of not being put out of a job, continuing to receive their benefits. When folks confuse large corporations with some big negative, thing, I just, get frustrated with that rhetoric, because, small businesses are important. And I think they're doing a great job of trying to continue to help and support the small businesses. Large businesses are important too. They're employing a lot of people. And, if we don't keep large businesses functioning, we're going to have, more problems also. So.
Great. Well, Jim, thank you for your time. I know you'll
Yeah.
probably do another one of these in a couple of weeks as we progress along. But as always, I appreciate your time, and you're changing by the hour. We'll see what happens as we move along here. But thank you again.
Yeah. Thank you. I hope all the students at Montclair are safe and well, and finishing out the semester online. And hopefully, the next time we do one of these, it'll be with some more positive news.
Absolutely. All right. Thank you, everyone.